All right, welcome to the deep dive. Today, we are absolutely diving headfirst into a corner of retirement investing, one that comes with some very specific rules you have to know if you're involved. We're talking gold IRAs and specifically the crucial, sometimes complex world of IRS reporting for these accounts. Now, this deep dive is fueled by some excellent source material shared by one of you, a detailed article titled Gold IRA IRS Reporting, Forms, Deadlines, and Requirements. Really lays out the essential ground rules.
And understanding these rules is, well, it's non-negotiable, really. Gold IRAs offer this unique way to hold physical precious metals within a tax-advantaged retirement structure, but, they aren't like holding stocks or bonds. The IRS has particular needs when it comes to tracking these physical assets. So our goal today is basically to pull out the absolute most important takeaways from this article, give you the key knowledge nuggets so you can feel informed, confident, without getting, lost in dense tax code.
Exactly. We're going to explore why these reporting rules exist specifically for precious metals, break down the specific IRS forms that are your roadmap, pinpoint the actions that actually trigger reporting requirements, hit the critical deadlines, and tackle some of the trickier tax nuances, like how physical distributions get treated. Let's unpack this.
Okay, let's start with the foundation. What is a gold IRA? At its core, it's a self-directed IRA. It permits you to own IRS-approved physical precious metals like certain types of gold, silver, platinum, palladium as investments within your retirement account. Could be a traditional or Roth IRA.
So instead of just paper assets like stocks, you're holding the actual tangible metal. Why does holding something physical like that make the IRS reporting different? Different than, say, a regular stock IRA?
Yeah, that's the key distinction, right? Because it's a tangible asset, the IRS needs specific accountability. They require clear information reported, usually annually, and also when transactions happen. Things like contributions going in, distributions coming out, and that could be cash, or the physical metal itself, and, crucially, the fair market value of the metals held. This level of tracking is really necessary to ensure compliance with tax rules specific to these kinds of accounts holding physical stuff.
Okay. So it boils down to tracking the physical movement and value of that metal, all inside that tax-advantaged wrapper. Got it. Now, the article walks through the specific IRS forms you're likely to encounter. It might sound like alphabet soup at first, but these forms really are how the IRS keeps tabs. What are the absolute must-know forms highlighted in the source?
Yeah, the article details a few critical ones. First up, when you sell precious metals from your gold IRA, that sale or disposition is reported using Form 1099-B. Now, this isn't necessarily a taxable event right then, but it's how the sale within the account gets documented for the record.
Okay, 1099-B for sales inside the IRA. Makes sense. What else?
Then, for contributions made into your IRA during the year, your IRA custodian, that's the IRS-approved financial institution that actually holds your physical metal for you, they're required to file Form 5498. This form reports your total contributions for the year, and, importantly, it also reports the year-end fair market value of your account assets.
So the custodian handles the 5498. Good to know.
Yes, mostly. There's also Form 8A938, which is for significant foreign financial assets. The article notes this can sometimes include precious metals held physically in a foreign country, even under a U.S. IRA structure. Probably less common for most folks, but it exists.
Okay, bit niche perhaps.
And finally, Form 88606. This one's used if you make non-deductible contributions to a traditional IRA. So while it's not specific only to gold IRAs, if you put non-deductible money into a traditional gold IRA, you use this form. It helps track your basis so you don't get taxed on those contributions again when you take money out later.
Right, tracking that basis is important. So it's not just one form then. It's a set depending on the action. Selling, contributing, maybe even where the metal's held. And it sounds like the custodian handles a lot of the filing, but you still need to understand what is being reported about your money.
Precisely. Your custodian is responsible for filing key forms like the 5498 and the 1099-B, absolutely. But you need to be aware they exist, what information they contain, keep copies for your own records. It's your account, your responsibility ultimately.
Okay, let's get tactical then. What specific actions actually trigger this IRS reporting for your gold IRA? What makes the IRS say, okay, we need a report on that specific move?
Right. According to the source, the main triggers are pretty clear. First and foremost, selling gold or other precious metals within the account. That definitely generates the need for that 1099-B we mentioned.
Okay, selling. Got it.
Second, taking distributions. This is a big one. Whether you withdraw cash that came from a sale or you actually take possession of the physical metal itself, that's called an in-kind distribution. Both are reportable events, usually on Form 1099-R.
Taking money or metal out. Okay.
And third, making contributions to the IRA. This includes your regular cash contributions, rollovers from other retirement accounts like a 401k, or potentially even direct contributions of eligible physical metals, though that depends a bit on the custodian's process, that activity. That gets reported on Form 5498 by your custodian.
So basically any significant movement or change, moving metal in, moving it out, selling it, puts it on the IRS's radar. Staying informed about these triggers helps you anticipate the paperwork or at least know what your custodian should be reporting on your behalf.
Exactly. Awareness really is your first step in staying compliant and, frankly, avoiding unexpected questions later on.
Now, here's where it gets really tactile. Dates. The IRS runs on deadlines. What are the crucial dates associated with Gold IRAs that you absolutely cannot miss based on this article?
Oh, yeah. Deadlines are critical. Okay, so for making contributions for a specific tax year, the deadline is typically April 15th of the following year, just like regular IRAs. But there's a crucial nuance for Gold IRAs highlighted in the article. If you're making a contribution that involves physical metal, the metal needs to be physically in the depository, the secure storage managed by your custodian by that April 15th deadline. It's not just about initiating the purchase.
Wow, okay, that's a key distinction. It's about the physical asset being in its proper, secure place by the deadline, not just ordered.
Yes, exactly. It adds a logistical layer you don't have with electronic contributions. Then you have the reporting deadlines that mostly fall on your custodian. Form 1099-B, which reports sales, is generally due to you and the IRS by February 15th. Form 5498, reporting the contributions and year-end value, that's due by May 31st. Now, while your custodian handles submitting them, you should definitely verify you receive copies of these forms.
February 15th, May 31st.
Yeah.
Got it. Keep an eye out for those from the custodian.
And a huge one, maybe the biggest deadline pitfall, is for rollovers. Specifically, indirect rollovers. That's where you take a distribution from another retirement account, you get the check yourself with the plan to put it into your Gold IRA. You have a strict 60-day window, 60 days from the day you received the funds to get them redeposited into the new Gold IRA. Miss that 60-day mark, the entire amount is suddenly considered a taxable distribution.
Ouch.
Yeah, subject to income taxes. And if you're under 59.5, potentially that 10% early withdrawal penalty too.
Whoa. That 60-day window sounds absolutely critical. Missing that turns what should be a non-taxable event into a potentially very, very costly mistake.
It's honestly one of the most common and expensive mistakes people make with rollovers, so that 60-day rule for indirect rollovers, paramount. Really watch that clock.
Okay, good warning. Let's delve into some of the more specific requirements and potential nuances the article mentions. It touches on the type of gold allowed and how distributions are treated. What are the specifics there?
Yeah, this gets into the weeds a little, but it's important stuff. The IRS has a pretty strict purity rule for most gold held in an IRA. It generally must be 99.5% pure. This is why common bullion bars and specific coins like, say, Canadian gold maple leafs or American gold eagles are popular. They meet that standard. The article does mention reporting can depend on type and weight, but that 99.5% purity is a core requirement for eligible gold bullion.
99.5% pure.
Okay. Now, one of the most significant points the article really hammers home is about distributions. Taking a distribution, whether it's cash from selling metal or taking the physical metal out of the account, is reported on Form 1099-R, and you must include that distribution when you file your personal taxes.
So any distribution gets reported, doesn't matter if it's cash or the actual metal.
Correct. Any distribution is reportable. But here's where it gets really interesting, and the article emphasizes this point heavily. The tax rate you pay can be different depending on what you distribute.
Oh. Okay, tell me more. What's the difference there?
Well, if you sell gold within the IRA and then you take a cash distribution from the proceeds, that cash is generally taxed as ordinary income. Standard IRA distribution rules apply. However, if you take a distribution of the physical gold itself, an in-kind distribution, maybe you take possession of some gold bars or coins instead of selling them first, the IRS considers that physical metal a collectible.
A collectible, like art or rare stamps.
Exactly like that. And distributions of collectibles from an IRA are taxed at a special maximum rate of 28%.
28%.
Yep, 28%. This rate is often higher than standard income tax rates, especially for many people in retirement. The article specifically calls out this 28% collectibles tax rate on distributions of the physical gold as a critical detail that many investors just overlook. It really changes the tax math significantly compared to distributing cash.
Wow, 28%. So just to be clear, if I plan to eventually take physical possession of my gold from the IRA, that distribution could be taxed at a potentially much higher rate than if I just sold it inside the IRA first and then took the cash out. That sounds like a major planning consideration.
It absolutely is. It highlights the crucial importance of understanding the tax implications of taking physical distributions versus cash distributions that come from selling the metal within the account first. This 28% rate on physical distributions is, I'd say, one of the key takeaways from the source material. Definitely something to remember.
Yeah, no kidding. Okay. So with all these forms, dates, potential tax curveballs like that 28% rate,
Yeah.
how does someone navigate all this and stay on the right side of the IRS rules? The source gives some pretty clear best practices, right?
It does. And the article's strongest recommendation, number one, is meticulous record keeping. Seriously. You need to keep detailed documentation of every single transaction. Dates, amounts, specific descriptions of the metals bought or sold, all your correspondence with your custodian, and copies of all the forms your custodian sends you, those 1099s, the 5498s. Think of your records as your primary defense if the IRS ever comes knocking with questions.
Okay, records, records, records. Got it. What else?
Beyond records, the source highly recommends seeking professional tax advice. This is especially important if you have complex transactions, if you're planning to take distributions soon, or if you hold a significant amount in your Gold IRA. Find a tax advisor who genuinely understands both retirement accounts and the specifics of precious metals investing. They can help you navigate the particulars of your unique situation.
Makes sense. Get an expert who knows this specific niche.
Exactly. The article also advises staying updated on IRS rules. Things can change. So periodically checking the IRS website or, again, consulting with your tax pro is just smart. And critically, ensure your custodian is reputable and diligent in their reporting obligations. While the ultimate responsibility for your tax return is yours, your custodian's accuracy on the forms they file is absolutely vital. Pick a good one.
Right. So it's kind of a combination of your own diligence with the paperwork, getting expert help when needed, and making sure your custodian is doing their part correctly.
Precisely. You could think of it as a partnership in compliance, but you're the one holding the final responsibility for what ends up on your tax return.
Okay. Audits. Just saying the word can make people nervous. The source does touch on this. Why might a Gold IRA specifically attract audit scrutiny, and what does the article suggest about preparing for that possibility?
Yeah, nobody likes the A word. The article mentions that audits can sometimes be triggered by inconsistencies in reporting. Maybe something you report on your tax return doesn't quite match what your custodian reported on their Form 1099 or 5498. That can raise a flag. Also, simply failing to report required information altogether is obviously another potential trigger. And of course, there's always an element of random selection in audits. However, the article does offer some reassurance here. If you have been meticulous with your record keeping, like we just discussed, an audit might simply be a routine process just to confirm everything lines up correctly. It doesn't have to be adversarial.
Okay, so good records are key even for audits. How do you prepare if you do get that notice?
If you do face an audit, the main preparation step is really straightforward. Gather all that documentation we've been talking about. Your transaction records, copies of every relevant IRS form you've received or filed, 1099s, 5498s, maybe that 8606, and any communications with your custodian. Having everything organized and readily available can significantly smooth out the audit process. It just reinforces that good record keeping isn't just a suggestion for tax time. It's essential preparation for potential scrutiny down the road.
It really sounds like solid preparation is the key to feeling more confident, even with the possibility of an audit looming.
Absolutely. Being able to quickly provide clear, organized documentation goes a very long way in those situations.
All right, let's maybe wrap up by hitting a few common questions the article addresses directly, things listeners might still be wondering about. First one, are contributions to a Gold IRA reported on your personal tax return?
Okay, so the contributions themselves are reported to the IRS by your custodian using that Form 5498. You then take that information from the 5498 when you prepare your personal tax return. You'll need it especially if you're claiming a deduction for traditional IRA contributions or if you're tracking those non-deductible contributions on Form 8606 we talked about. So custodian reports it, you use their report for your filing.
Gotcha. Custodian reports you use. Okay. What about transferring a Gold IRA from one custodian to another? Like if you switch providers, does that need reporting by me, the account owner?
Generally, no. If it's a direct trustee-to-trustee transfer, meaning the metal and any funds move directly between the two custodians without you ever actually taking possession, that's not considered a distribution. So typically, it does not require reporting by you, the account owner, on your tax return. Your new custodian will just start reporting the assets received on your future year-end Form 5498s.
Good to know you don't usually have to worry about reporting those seamless transfers. Okay, we touched on this, but just to reiterate for absolute clarity, what are the tax implications, again, for selling gold within the IRA itself?
Right. The article is very clear on this. Selling gold inside your IRA is not a taxable event at the time of that sale. The tax liability only comes up later when you actually take a distribution from the IRA, whether that's cash or the metal.
Perfect. Tax deferred until withdrawal. Are there any real exceptions to the reporting requirements for gold IRAs? Anything that doesn't get reported?
Very few, honestly. As we just mentioned, that direct trustee-to-trustee transfer is the primary example of an event that involves the assets moving, but isn't a distribution and doesn't typically require reporting by the account owner. But most other significant actions, contributions, rollovers where you touch the money, and especially any kind of distribution definitely trigger reporting requirements.
Okay, so assume most things need reporting unless it's that direct transfer. And finally, what's the article's ultimate advice for avoiding penalties related to Gold IRA reporting? What's the bottom line?
The core message for avoiding penalties really boils down to two things: accuracy and timeliness. Report all the required information correctly and make sure it's filed on time. Keep those detailed records we keep emphasizing, and please don't hesitate to get professional tax help if you're even slightly unsure about anything. Proactive compliance is absolutely the best strategy to steer clear of penalties and headaches. So, as we kind of step back from this deep dive into the source material, the central message seems pretty clear. Gold IRAs have these distinct reporting rules. They involve specific forms, very important deadlines, and certain triggers like sales and distributions that you need to be aware of. Mastering these details isn't just about, tedious paperwork. It's really essential for protecting your retirement savings from potential and sometimes costly IRS issues.
Absolutely. Understanding these points, especially those key nuances like that potential 28% collectibles tax rate on physical distributions, it empowers you. It lets you invest in precious metals for retirement with your eyes wide open, helping you avoid potentially expensive pitfalls down the road. It truly pays to be informed on this.
Yeah, and thinking specifically about that 28% tax rate on physical distributions, comparing that to how other typical retirement assets are taxed when withdrawn. How does knowing that potentially change your perspective, not just on investing in physical gold for retirement, but maybe on the critical importance of planning your exit strategy, how you actually intend to take distributions years, maybe decades down the line right from the very beginning? It seems to add a whole other layer of foresight needed for these unique, tangible assets, something to think about.